On July 1st, the U.S. economy entered its 121st month of recovery following the end of the Great Recession in June 2009. It's the longest period of economic growth in our nation's history. During the current record setter, our economy has grown at an average of about 2.3% per year. But the rate of that growth has slowed in recent months.
Analysts over at Fannie Mae predict that GDP growth will drop to 2.1% in 2019 and slide to just 1.6% in 2020. And in an op-ed published in The Hill, Fannie Mae's senior vice president and chief economist Duncan compares the current era of economic expansion to a baseball game, saying that we are now in the bottom of the ninth inning. He joins us now to expand on this. Doug, great to have you.
Great, thanks for having me.
So what are the underlying trends here that have led to this sort of diagnosis?
Well, we picked up speed a couple of years ago. We got to about the 3% growth pace. Most economists think if you add the growth of the labor force and current levels of productivity, that'll kind of give you an idea how fast the economy can grow without getting out of balance.
Okay.
And the addition of those two things is around 2.25%. So we're pretty much at where
you would expect
trend growth. That's right. But of course, part of that is the impulse that was from the tax bill and the additional spending, and those things wane over time.
So that was kind of a sugar high.
A little bit, that's
Yeah.
right. Part of it actually, though, was long-term beneficial, and you've seen that in a little bit of the pickup in productivity, which has picked up from very low levels during most of this expansion. The risks are that the discussions on trade and the uncertainty that's been introduced into the business planning horizon is actually going to lead to less investment. And it's investment in plant and equipment that make workers more productive and allow you to pay them more in a non-inflationary way.
Well, here we talk a lot on this show about what you just talked about, which is about economic indicators versus structure of the economy. So, okay, like the economic indicators may not be great, but if you're increasing productivity and domestic investment, then you have a better structured economy for a nation that wants to be strong. How do you balance that in your projections?
Well, our expectation is that investment's going to drop, and it actually has been. If you look at there's two things to look at. One is the survey data about attitudes.
Sure.
The other one is what's actually happening. And so we track both of those things. What's actually happening is that business investment has dropped off from a growth that we saw at the original point of the tax bill. That's of concern to us because it suggests that the recent growth in productivity may also wane because those two are linked.
Right.
What is an inverted yield curve and why should people care about it?
An inverted yield curve is a situation in the market where short-term interest rates are higher than long-term interest rates. So today, the government borrows money all along the time spectrum. The 3-month Treasury bill rate is higher than the 10-year Treasury bill. There's two or three things that could signal. One is that the market expects the Fed to cut rates, which it does. That's clearly the case. That growth expectations in the out years have fallen, which they have in our forecast, and that when you look at global capital markets, most countries, developed countries, 10-year treasuries, equivalent of the U.S. 10-year treasury, are actually earning negative interest rates. That suggests people would be sending capital to the United States in that time frame and holding long rates down. That's part of the reason people are saying, well, maybe this time is a little different about an inverted yield curve because it's a global capital thing.
Because often this is a recession indicator.
Right, and it's the strongest recession indicator, as I understand.
It is highly correlated with it, but it's correlation as opposed to causation, right? Those are two different things. They may happen and look like they're related.
Doesn't always lead to recession.
There's
it doesn't
been
always
some falls.
come.
That's right. There's been some falls.
Well, so like bare bones, I mean, what does this really mean? I mean, look, this is all basically like voodoo, if you ask me. And I have a degree in economics.
We both have degrees in economics.
I mean, I've looked at forecasting for a long time. We get it wrong literally all the time. But I mean, there are a couple general trends that we need to highlight. What are they? What are the top 3 trends that we need to know going in for the next year?
We appear to have reached the end of 40 years of trade liberalization, and the discussion now is a very different discussion. That definitely increases uncertainty. Is that going to be a sustained change? And you see not just the political turmoil here, you see it in Germany, you see it in Italy, even China. This is a kind of a global thing. So that's the global side of the equation. In the U.S., the question in the long term is, what are we doing about debt? If you look at the out years, our entitlements are not going to be funded going forward. We're not really addressing that. We're running very large deficits relative to GDP that compiles into a large debt. That's going to become a pressure on economic growth. And you probably have seen a couple of the economists have written a book talking about this time is different, saying, look, when debt to GDP approaches 100%, there's no way you can grow rapidly. So to me, that's the other long-term question is what are we going to do about debt?
Well, what's China's debt to GDP ratio?
It depends on how you trust their statistics.
Which I don't.
Right. It's bad, at least as bad as ours.
Okay.
Interesting. So, I mean, one of the trends that I'm sure Sagar and I both learned in Econ 101 is this idea that as productivity goes up, wages rise, and that was the case for a number of decades during the sort of greatest expansion of the middle class in American history post World War II. Somewhere around the 70s, that relationship broke down. No longer the case. Productivity continued to increase, and wages basically flatlined. What do you think is the cause of that?
Well, I do think there's a relationship between the debt issue, which raises questions about the value of investment. We're a pretty mature economy. We have a large part of our labor force, the boomers, that are going to go into retirement. When they go into retirement, they take with them maximum skill level that they have across the course of their life. The next group, the millennials, which is the next largest population group, is still gathering skills and coming into the workforce. So we have kind of an averaging down in the interim just because of the nature of our demographics. But you do have to...
Well, we're talking about a 40-year trend here at this point, though.
It's not that long. It's about a 20-year trend, but clearly, and the first stages of this expansion, very low productivity gains. That has picked up. We've also seen incomes pick up. The most recent 2 or 3 labor reports, 2 or 3 months of labor reports show that we're now back at wage rates that are at the average of World War II through 2000, about 3%. But the fact is, for most of this expansion, well below that average. Part of the reason there's dissatisfaction publicly with where the economy is.
Well, I think
it's good news that we're back to that average, though.
Right. Well, I think it's
most
more
of it's
about
in the
how we
lower
return to that average, right? It's about how people are getting to those wages, or the number of jobs, and the lack of benefits. And this is what we were talking about. I mean, it's really 2016 was the return of political economy in this country, which we, instead of looking at growth as the number one indicator, we were talking about, oh, well, maybe if we sacrifice some growth, or if we reduce our trade reliance on China, we'll become a stronger nation. And that really goes to, I think, a more philosophical discussion. As somebody who works in the field, how do you guys balance that? Because Crystal and I mean, we were trained, it's classical economics, and most of the economists I know in the Wall Street sector are very much, I mean, it's anathema to them to question an American trade relationship if it were to affect the bottom line by 0.001%. So how is it that you guys think about that and balance it as somebody who's worked in the industry for a long time?
Well, I think the trade story is still the same. I think most economists would tell you American consumers are going to pay the price for.
But the question is whether Chinese consumers pay even more of a price.
Well, China, in my view, is a special case because it's not just about trade in China. It's about the theft of intellectual property. Sure. It's about security of shipping lanes. We have input flows for some of our production that require relationships with Southeast Asia for things like microchips and things that are produced there and shipped here. For example, I had a coworker that has an Audi, which in the bumper has the cameras, which in the year of Audi that he bought, the cameras aren't there because there was the nuclear meltdown and tsunami in Japan, which is the source of those things. So you talk about supply chains, it's a global supply chain. So there is a risk to trade of disrupting those food chains, those global food chains.
Is there, last question for you, is there any grappling though within the economics industry around what Sagar's talking about? Because I mean, look, NAFTA's a perfect example. I don't doubt that NAFTA increased our overall GDP. The question is not that. I also don't doubt that NAFTA devastated a lot of Midwestern communities that have never recovered. So the question is not just what is the top line macroeconomic growth. The question is also who benefits from that growth. Do our current economic indicators really reflect the experience for the average American?
I think you're right on point with that. The vast majority of economists would agree that freer trade is better than less free trade. But they would also have to acknowledge that while at the aggregate level it benefits both countries, the distribution of those benefits within country varies significantly.
If you're living in
That's
Youngstown,
exact.
you don't care that much about the aggregate level.
Right. I mean,
That's exactly
we've been
right.
sold the story that because we built up China's middle class, that it's okay that we lost much of our own. And I think that is something that, I mean, it's something we talk a lot about here on the show, but
Well, I think that's clearly reflected in voting patterns in the United States. No doubt about that. I spoke in Fort Wayne, Indiana recently. The mayor was on the dais before me, and we had a conversation after that. And he's like, "Well, what do we do?" Fort Wayne at one point had the highest share of any city in the United States of its workforce in manufacturing.
Yeah.
They were devastated by the out migration of those jobs.
I mean, most middle tier and smaller cities are being hollowed out right now. I mean, rural America is being destroyed. So
I grew up in western Minnesota, so I have family members that relate that information to me regularly.
Thank you for joining
Doug,
us,
thank
sir.
you. Great to have you.
My pleasure.
Appreciate it. Next on Rising, just days after Joe Biden unveiled his health care plan, we discover his national campaign chair has some interesting ties to the healthcare industry.
And the Democratic debate matchups, who is paired with whom, and will there be fireworks? Team Rising is coming up. Make sure you stick around.